Good afternoon, ladies and gentlemen. Welcome to the first Financial Stability Forum of 2024. My name is Marama Mburu, and I will be your program director for today. So our panel today is chaired by our governor, Lisa Kganyago, and he is joined by our deputy governors, as well as some of our colleagues from the Financial Stability Department. So today we're releasing the first edition of the 2024 Financial Stability Review. The review is part of our statutory mandate to protect and enhance financial stability in South Africa. Through the FSR, the South African Reserve Bank communicates the assessment of South Africa's financial system over the past 6 months, as well as its assessment of some of the risks to financial stability over the next 12 months. In the FSR, we also communicate some of the policy steps that we've taken. I would also like to acknowledge today the presence of our former Finance Minister, Nhlanhla Nene. You're welcome, sir. So for the program for today, we'll start with some opening remarks from the governor, after which we'll have a presentation from Herco, and then we'll conclude with opening the floor up to questions and answers by people in the room as well as those joining us on our digital platforms. Without any further ado, I'll give it over to the governor. Go ahead, Governor.
Thank you very much, Munaro, and good afternoon. Good to have once again a physical meeting, and this is Africa. When you are in trouble, you appeal to the ancestors, and I'm glad we have an ancestor in our presence. This forum, we hold it to reach out and engage much more broadly with the public. And this particular one comes at a pretty interesting time because it is almost had back to back with what we had called the Talk to the SARB Forum, which was held in Soweto last night, which was also went very well. And I am so pleased to see so many of you. But why are we here? The Financial Sector Regulations Act, and I had to talk about the ancestor because when the PA was launched, he was the Minister of Finance. So he is like the real ancestor of the Twin Peaks model. And so the Financial Sector Regulation Act tasked the South African Reserve Bank with the responsibility of promoting and maintaining financial stability. And in promoting and maintaining financial stability, we have to identify and assess key risks that could undermine financial stability, as well as monitor the strengths and weaknesses of the domestic financial system. I can assure you that the South African financial system is resilient. And it is resilient, and for the following reasons, I'd like to point out a few institutional changes that had taken place that makes us more resilient. In April this year, the Corporation for Deposit Insurance, CODI, came into effect. I'll not bore you with the details of what it covers. Suffice to say that CODI will make sure that just over 90% of all the depositors in South Africa that are covered would be met should the institution with which they had placed their deposit had failed. It's a very important milestone. But we have also this year made significant progress in implementing resolution standards since the SARB was designated as a resolution authority on the 1st of June last year. And this becomes important because several of these prudential standards are being developed to further increase the robustness of the domestic financial systems. And these include stays and resolution moratoria and the transfer of assets and liabilities in resolution, flag requirements, valuations, and resolution valuations, as well as resolution groups and funding in resolution. And so every financial institution have to have a plan of some sort to prepare themselves should they face a challenge, to be able to facilitate the resolution of that institution. This is one of those things that you want to have in place and hope that you never have to use it. We also published an updated macroprudential policy framework and the decision-making process, as well as updating the financial stability monitoring and assessment framework. And you will hear more from Herco when he does the risk and vulnerability matrix. And again, during the course of last month, on the 21st of May, we issued a directive on cybersecurity and cyber resilience in the national payment systems. What is clear is that every institution, every jurisdiction must prepare itself for some form of a cyber attack. That you would be attacked is a given. The only thing that distinguishes you from the rest is how quickly you come up after you have been attacked. And we have had to issue these standards to make sure that the financial institutions have got plans in place that should they come under a cyber attack, they would be able to come back up. And the Prudential Authority this year had also published guidance notes on climate-related disclosures, governance, and risk practices for banks and insurers aimed at increasing financial sector resilience against these risks. If you thought that climate change is some form of fake news, you just have to look around here in our country. We're facing a situation where we think we would be faced with drought, and at the same time, you are having floods in other parts of the country. I thought that tornado was something that only exists in North America somewhere, and suddenly we have had tornadoes in KZN. And one of the insurers had to come and started to estimate how much they would have to pay out. And if these events start to occur with a regularity, then you know that climate change is a reality and that we better be assessing the risks associated with this. And so that is what we face with. And although we have had various policy actions that have increased the resilience of the financial system, it is nonetheless facing several risks to financial stability. These risks, which Herco will go through, include the high levels of government debt and debt service costs, as well as the financial sector's high exposure to the sovereign. The SARB continues to monitor these developments around the sovereign financial sector nexus closely. You have seen this happen elsewhere in the world, and we had to be alive to that. And lastly, one of the ways in which we actually assess the resilience of financial institutions is to test their ability to operate in severe but plausible scenarios. In other words, it's not good enough to say, I have a plan. Is your plan battle ready? And so the stress test is meant to test the readiness of those plans to withstand those adverse scenarios. In the past, the stress tests were limited to the banking sector. However, in the 2023-2024 period, we conducted our first comprehensive stress test of the major insurance companies. The results of the stress test are shared in this document, the first edition of the Financial Stability Review. And also in the 2023-2024 financial year, the Insurance Common Scenario Stress Test subjected systemic South African insurers to a series of severe shocks and scenarios. The exercise is highlighted that firms are adequately capitalized to withstand the shocks and the scenarios considered. However, the results suggest that the insurance industry is moderately susceptible to unfavorable market movements and deterioration in the credit quality of insurers' counterparties, which non-life insurers are significantly vulnerable to an increase in the claims ratio. Overall, the South African financial system remains resilient. This was despite uncertainty over the outcomes of domestic elections. The sky didn't fall on Chicken Little's head, and as well as we had seen that we were not the only ones. And when people asked about what about the elections, there are 70 other countries that had been voting, that will be voting during the course of this year. There was unhappiness in the financial markets that there is no clear winner in South Africa. In Mexico, the market tanked because the winner won too much, right? So you never know. You win a little, you are in trouble. You win too much, you are in trouble, and that is the uncertainty that we actually face across the globe. But the risk factors that dominated global financial markets include intensifying geopolitical tensions over the conflict in the Middle East and the Ukraine, a sticky inflation that may require interest rates in advanced economy to remain higher for longer, and persistently high levels of government debt across the globe. And lastly, is the issue of geopolitical fragmentation and what is called friend shoring. So you have got the world as we know it, and countries want to deal only with others. We are faced with exactly the same risks of global warming. We all need access to the technology so that we can counter the effects of global warming. And yet, some with the technology feel that the technology cannot be shared with others. Some with the materials that you need to counteract climate change feel they want to keep the materials for themselves. The thing with climate change and global warming is that we have one planet. So you can't keep your own part of the planet cool whilst the rest of the planet is warming up. We have got one planet. It will warm up and mess up the future of all of us. With that, let me hand over to someone who will not mess your future. It's Herko Stein. He will walk us through a presentation on the financial stability review. Herko?
Thank you very much, Governor, and good afternoon, ladies and gentlemen. I have a few slides that I'll run through in about 15 minutes or so before handing back to the Governor and Mulalo for the Q&A session. So starting with just a brief overview.
Climate change.
So cyber event. Oh, there we go. Okay, so Section 4 of the Financial Sector Regulation Act, or the FSR Act, defines financial stability as meaning that financial institutions and market infrastructures are able to provide financial products and services and perform their functions without interruption and despite changes in economic circumstances. In essence, financial stability refers to a financial system that exudes and inspires confidence through its resilience to systemic risks and shocks, and its ongoing ability to efficiently intermediate funds. Without financial stability, there is a heightened risk of the financial system experiencing disruptions in financial intermediation that could adversely affect or impact real economic activity. Among other things, the FSR Act mandates the SARB to assess the stability of the financial system during the 6-month review period, and then also to identify and assess risks to financial stability in at least the next 12 months. The FSR Act also requires the SARB to monitor and keep under review the strengths of the financial system, and this edition of the FSR aims to balance the identified risks with factors and actions that increase the resilience of the financial system against the highlighted risks. Point worth emphasizing is the fact that although the FSR Act assigns a lead role to the SARB in protecting and enhancing financial stability, the legislation also empowers several other financial sector regulators to support the SARB in pursuing this mandate. So the FSR is tabled in Parliament and aims to stimulate debate on pertinent issues related to financial stability in South Africa. The key global developments of relevance to financial stability since the release of the November 2023 FSR are the growing evidence that steady progress towards sustained disinflation is being made, although there is emerging global concern around sustained fiscal deficits coupled with high levels of government debt and elevated government or debt service costs. Factors that could impact market volatility include the elections in more than 70 countries, geopolitical tensions, and possible policy rate divergence. When the November 2023 FSR was published, policy rates in advanced economies were at or near their peaks, with expectations that interest rates in advanced economies would start declining by the first quarter of 2024. However, the latest forecasts reflected in the graph show that expectations of rate cuts in selected advanced economies have been moved out to the second half of the year. In the graph, the solid line shows the actual policy rate, the dotted line shows the expectations in November 2023, and the dashed line shows expectations in April 2024. Advanced economy sovereign bond yields have increased as markets priced in higher real rates and more persistent inflation. As spreads between yields on emerging market debt and US Treasuries narrowed, the relative attractiveness of more risky emerging market debt waned. This could result in reduced capital flows to emerging markets, currency depreciation, and higher costs for new and refinanced debt. Moving to the outlook for financial stability, as reflected in the SARB's Risks and Vulnerability Matrix, or RVM. The RVM reflects the residual or net vulnerability of the financial system against the identified risks and considering existing mitigating factors. In this context, vulnerability denotes a property of the financial system that reflects the existence or accumulation of imbalances, which may increase the likelihood of a shock, or when impacted by a shock, may lead to systemic disruption. So this is the RVM from the November 2023 FSR. The only risk that was removed from the RVM is the one of further deterioration of household and non-financial corporate buffers, as this is included in the discussion in the current FSR or in the June 2024 FSR on the impact of interest rates remaining high for longer in the current FSR. Items marked with an R indicate that they have been retained but rephrased from the November 2023 FSR. The risk posed by a sharp repricing in government debt has been rephrased as the weak fiscal position and the sovereign financial sector nexus. And then tighter financial conditions for longer has also been shortened to tight financial conditions for longer, while remaining on the FATF grey list for longer has been changed to remaining on the FATF grey list beyond June 2025. The perpetual risks facing the South African financial system have been stripped out from the RVM. These are risks that have become so structurally entrenched that they have become perpetual in nature and include structural impediments contributing to low and inequitable economic growth, cyber risk and climate risk. The key risks to financial stability are discussed next. The structural challenge of poor economic performance continues to weigh on South Africa's attractiveness as an investment destination. Since 2009, South Africa's economic growth has lagged behind that of the world, advanced economies, emerging markets, and sub-Saharan Africa. South Africa's debt stands out compared to emerging markets or other emerging markets. South Africa's debt to GDP ratio of 73.7% is well above the emerging market average of 58.9%, as seen in the left graph, and its interest to GDP ratio stands at 4.7%, compared to the emerging market average of 3.1%, as reflected in the right-hand graph. South Africa's debt service costs are projected to remain above 20% of main budget revenue in the medium term, which is well above its long-term average of 13%. South Africa's elevated debt ratio, coupled with high borrowing costs, mean that debt service costs continue to be one of the fastest growing expenditure components for the government, as reflected on the left graph. The relatively large financing requirements of the government place upward pressure on government bond yields and increase costs across the financial system, as shown on the right graph. The weak fiscal position exacerbates the sovereign financial sector nexus, most notably by exposing the financial system to market risk in the event of a sharp repricing of government debt and undermining market resilience as the financial system is increasingly exposed to a common risk. The November 2023 FSR includes a detailed discussion of the sovereign financial sector nexus, and I encourage you to read this edition of the FSR together with the previous one. South Africa's capital markets have become shallower and less liquid over the past few years, which reduces the diversification options of both borrowers and investors. In addition, as seen in the top graph, the government has increasingly dominated issuance in the domestic bond market, increasing its share of total outstanding bonds from around 60% in 2008 to 81% as at the end of February 2024. The bottom graph shows that there have been net company delistings on the JSE every year since 2016. The turnover in both the domestic bond and equity markets has also declined in recent years, further contributing to declining market depth and liquidity. And this issue is discussed at length in the May 2022 FSR. High policy rates contribute to more restrictive financial conditions by making credit more expensive and more difficult to access. As seen in the graph, the banking sector's non-performing loans, or NPLs, for the largest asset classes are at their highest levels in a decade. This could result in rising credit losses, which could reduce bank capital and profitability. However, the uptick in NPLs is mitigated by banks increasing their provisions for potential credit losses. Banks have been increasing their provisions faster than credit is being extended, as reflected by the growing value of impairments raised, which suggests that banks should be able to absorb a further increase in defaults. Moving to the issue of an insufficient and unreliable electricity supply, as seen in the graph on the left, Eskom's energy availability factor averaged approximately 52% in the first quarter of 2024, before improving notably to 58.2% at the end of April. The rapid uptake of alternative energy sources is likely to have contributed to reduced demand for Eskom-supplied electricity, as per the graph on the right. According to Eskom estimates, a rooftop solar capacity of approximately 5.5 gigawatts had been installed as of 30 April 2024, compared to 3.1 gigawatts in January 2023. In addition, new electricity generation projects, primarily by the private sector, registered with the National Energy Regulator of South Africa, totaled 4.49 gigawatts in 2023. This is compared with 1.66 gigawatts for the entire 2022 and brings the cumulative generation capacity of registered projects to 7.2 gigawatts as at 30 April 2024. The confluence of these factors, coupled with broader energy sector reforms and ongoing efforts by Eskom to stabilize the performance of its coal-fired power stations, suggests that electricity supply and grid stability may continue to improve gradually going forward. Then, as also highlighted in the November 2023 FSR, the ongoing uncertainty associated with simmering geopolitical tensions could result in heightened market volatility, with resultant implications in terms of the level and direction of existing trade and financial flows, supply chain constraints, and disruptions in international transport systems. With regard to the impact of the FATF grey listing, after the European Union added South Africa to its list of high-risk countries in June 2023, The United Kingdom also classified South Africa as a high-risk third-party country in December 2023. Then subsequently, the European Securities and Markets Authority, or ESMA, de-recognized JSE Clear as a qualifying central counterparty with effect from 29 December last year. The risks and associated implications of the FATF grey listing are again discussed in greater detail in the May November 2023 editions of the FSR. Then against the identified risks to financial stability, I move to the policy actions and initiatives undertaken to enhance financial stability and increase the resilience of the South African financial system. Most notably, these include the operationalization of the Corporation for Deposit Insurance, ongoing progress with resolution standards, introducing a positive cycle-neutral counter-cyclical capital buffer, mitigating the sovereign financial sector nexus, increasing the financial sector's resilience to deal with the national electricity grid shutdown, collaborating with FSOC members, enhancing macroprudential policy transparency, and increasing the financial sector's resilience against cyber and climate risks. Then moving to the SARB's overall assessment of financial stability, the South African financial system faces several risks to financial stability as highlighted by the Governor and indeed in this edition of the FSR. However, steady progress has been made to reduce the vulnerability of the domestic financial system and increase its resilience against the highlighted. Financial institutions have been able to provide financial services uninterruptedly, which is central to the definition of financial stability, and prudentially regulated financial institutions remain resilient, as demonstrated by their ability to maintain adequate capital and liquidity buffers. Then lastly, this edition of the FSR provides an overview of the SARB's 2023-24 Insurance Common Scenario Stress Test, or ICSST, and the key results. The ICSST is the second macroprudential exercise to be conducted on the South African insurance industry and is an enhancement of the 2020-2021 exercise. The scenarios included various single-factor market and underwriting shocks, as well as domestic and global adverse scenarios. In line with the key risks identified in this edition of the Financial Stability Review, the domestic adverse scenario aimed to capture South Africa's idiosyncratic risks, primarily weak economic growth, the energy crisis, and high interest rates. In the global adverse scenario, shocks emanated from elevated geopolitical polarization, strong and persistent global inflationary pressures, and the deterioration in global sovereign debt sustainability. Participants in the 2023-24 exercise were 5 life insurance, accounting for roughly 60% of total assets of the life insurance segment, and 4 non-life insurers accounting for more than 49% of total gross written premiums in the non-life segment. The results show that insurers remain adequately capitalized under most of the single-factor shocks. Life insurers appear more resilient to the shocks and have inherently high levels of solvency capital requirement, or SCR ratios, than their non-life counterparts. The results further indicate that life insurance companies' SCR ratios are relatively more sensitive to market shocks, while the non-life segment is mostly vulnerable to increased claims. Under the most severe shock, life insurers' SCR ratio decreased from 2.18% to 1.91%, while life insurers' SCR ratio declined to 1.37% from a pre-stress level of 1.56%. This, however, remains well above the regulatory minimum of 1%. Overall, the results indicate that the participating insurance firms are adequately capitalized to withstand the shocks and scenarios considered. And with that, I thank you for your attention and hand back to Mlolo.
Right. Thank you, Herco, for the presentation. Now we'll open up the floor for some questions, and then the governor will tell us who is answering which questions.
No, I'm referring the questions to you.
There's people with roving mics, so if you just put your hand up.
I'm going to refer the questions to you.
Not today, Governor.
As usual, just please identify yourself and your affiliation. I know we did an insurance common scenario stress. I hope no one is stressed now. Right at the back.
Good afternoon. Good afternoon. My name is Kandani Msibi. I'm from Nomsa Investment Company. The report identifies climate change and the cyber risk and then the debt servicing cost as risks. But I think it's omitting unemployment as a risk to this country. That with increasing unemployment without any action to actually start creating jobs for the hundreds of thousands of young people that are getting to the job market every year, we are actually we will get to a point where we will have a revolt in our hands, and all of these mitigating factors will actually count for naught. Unfortunately, some of the mitigating factors for a risk, if you look at climate change, right? I think the banks have been pushed to a position where they don't fund hydrocarbons, they don't fund coal, and then the report also indicates that it is in ESCOM getting the coal fleet working that we actually have a stable electricity, even though also a stable electricity is coming from coal, right? Which, if you follow the global warming narrative, we should not be investing in coal. We actually should be shutting down coal power plants at a much faster rate. So I think there's a bit of a contradiction in terms of the views that have been taken, and because these things are put in different slides, you kind of don't look at them together, right? You need to put global warming, put power as a problem, put unemployment into one slide, and recognize the contradiction that exists there. The other part is the higher interest rate, right? Which on its own is actually also distressing business, in that when interest rates are higher, entrepreneurs don't take a lot of risk in the market, investing in new products or investing in risky projects that could, by their nature, create the kind of employment that you require in order to move the country forward. So I thought I should raise those contradictions and get a response. Thank you.
Thank you, Lindley. Thank you, Governor. My name is Yanni Rousseau from Wits Business School. Harold Wilson once said, in politics, a week is a long time. Now, since South Africa's election last week, we can say in South Africa, in politics, an hour is a long time, running up to the formation of coalitions. Now, unfortunately, some of these parties that might be included in coalitions had in the election manifestos the nationalization of South African banks. So at what point in time does talk of nationalization become a financial stability risk? How should we assess that? What is the Reserve Bank's view on that? Thank you very much, Governor.
Thank you. One more. Anybody online? Just one from online.
Just one from online.
Can you make sure that, yeah.
So we have one online. The financial stability assessment identifies the weak fiscal position as a risk to financial stability. Will the GFECRA arrangement have an impact on this outlook?
Okay. Of course, we can't put these things on one slide, but it doesn't mean that they are not captured. Sometimes the scales just do not work. Trying to put climate change and cyber on the one slide with unemployment and so forth. Be that as it may, let's deal with this. Can we move from the premise? We have convinced ourselves. We know that. Between 2004 and 2008, this economy was growing by an excess of 5%. During that period, for every 1% percentage point of growth, the economy created 0.7% of jobs, additional jobs. These things don't always hold, these elasticities, they change over time. In the period from 2012 throughout, this economy could not grow by more than 2% on average. Surprise, surprise, we didn't have jobs. You get the gist now. You want jobs, you must grow the economy. Absent the growth in the economy, you cannot get the jobs. You can't beat an economy that is on its knees and hope that you will get jobs from it. Now, there is a slide in the pack, which these slides will be available. And our point of departure about these risks was the structural constraints to growth. And if there are structural constraints to growth and this economy cannot grow, it will not be able to create jobs. So we have identified this as a risk right up front. Right up front, we identified this thing as a risk. That deals with why this economy is not creating jobs. And so we see unemployment as a risk. Yes, of course, people who are unemployed and therefore do not have incomes will have problems. They will be restless. But we are looking at the wrong place. The correct place to look at is that this economy has got a structural problem that it is not growing and therefore not creating jobs. So we like, as South Africans, to whip ourselves into this thing. Our problem is just unemployment. And therefore, our focus should be on we must create jobs. Let's change this narrative. You talked about entrepreneurship. Governments don't create jobs. Jobs are created by businesses. So if you want jobs created, make sure that businesses are created alternatively, and governments are also not very good creating businesses. Alternatively, create an environment for businesses to thrive. Then you are going to get growth, then you are going to get employment, then you will have lower unemployment, and thus you are going to have lower inequality. It's as straightforward as that. It's a basic economic relationship. It does not need complicated modeling or anything like that. It's just basic economic relationships that you get from an Economics 101 textbook. Banks' allocation to hydrocarbons, this had been a global thing. We have resisted having to incorporate such things into our prudential conditions. We have resisted it because we do not think incorporating that into the prudential conditions is a correct policy response. The correct policy response is to have functioning carbon markets and incentives and disincentives so that you can have a just energy transition. And underline that just is very important. And so, does that change what allocators of capital think? Well, major fund managers would controlled in excess of 70 trillion rand signed this declaration at the United Nations that said they are not going to do that. So you can decide to ignore them. Just accept that you will not have access to that money. So South Africa took a stance that is actually revered around the world because it is actually a very pragmatic approach to this. To say that whilst we are making the transition, understand that the base energy that we have is still based on coal, and that we will keep this. And to the extent that we must shut down certain plants, we will shut them as additional capacity comes onto the onto the grid. And that has been the approach that, as I understand, the way government has been doing it. But just energy transition has to be funded. And the question that needs to be asked is, where you have emerging market economies also faced with significant debt burdens, you can't fund the just energy transition by just piling those countries with debt, because the debt is already elevated. It will not be sustainable. You'll just be creating another problem. And hence the concept of blended finance and that sustainable finance. That is where the thing comes in to try and level that playing field. As I said, we have got one planet, but these contestations are going to take place globally and nationally. What is in no doubt in policy is that there will be winners and there will be losers. The role of government is to manage that contestation between winners and losers and take rational decisions that are in the best interest of all of us, and not take sides. The important thing is that when you have identified losers, how do you make sure that they are transitioned and you cushion the extent of the impact of those losses? And so, and the South African Just Energy Transition Plan is taking care of that, as far as I can, I'm concerned, and as far as I could read it. Higher interest rates impact on businesses. Of course they do. But you are having the wrong starting point. You are having the wrong starting point. We should be saying high inflation is making business decisions uncertain. High inflation is making business decisions uncertain. High inflation is making households to spend an increasing chunk of their income that they hadn't planned to spend because inflation is higher. And so the notion then that would say that if we have a little bit of inflation, we can have a little bit of growth. And so what's going to happen? The price setters will say, oh, inflation is higher than what I have expected, so I am increasing my prices higher. And because they increase prices higher, you are now faced with a situation where prices are rising, they're eating into the income of households once again, and you are in that spiral. And by the time you realize you must do something about inflation, your growth is dead. And for you to then deal with the inflation monster requires so much more policy action. Put simply, inflation is the disease, interest rates are the medicine that we administer to deal with the disease. If the patient does not take the medicine, the patient is going to end up in surgery or in a morgue. Our tasks as the South African Reserve Bank is thus to deal with that inflation monster so that this patient does not end up in surgery or end up with the funeral undertakers. That's our job. Yani, nationalization of South African banks. You know, in a way, our task is to understand that the political marketplace is very different from the marketplace we deal with. And the parties might say that they will be nationalizing the banks. Our job is to respond to what is government policy. Until that becomes government policy, we would not have to respond. But if government somehow nationalizes all of these banks, this government will have to borrow a lot of money because these banks are not particularly cheap at the moment, and you are not going to take them for free, right? You're not going to take them free, you have to pay for them. And they are not particularly cheap. And I mean, just judging by the market capitalization of the South African banks, they are way in around the biggest ones, just over 200 billion rands. And you add these things up, government would easily more than double its debt just to buy the banks. But if government has got so much money that they can go and buy the banks, why don't they use this money to build the roads and right? And so we've got to think about these trade-offs. And one of the things I had learned as a public servant for the best part of my life is that governing is sobering. Governing is sobering. You can make the promises the way you want. At the end of the day, when you govern, you are going to face the reality that you only have so much resources to work with. And if you try to do things beyond those resources, you're going to end up having to pay for it. And it would not take long before the funders start saying, I am not funding you anymore. Then you are left with only one funder who will come to the party, is the International Monetary Fund. They know one thing when they come. They will teach you how to budget. And they will make you to live within your resources. And it's going to be painful. And you know what? You might not have to drink the medicine. You might have to undergo surgery. The question online that deals with weak fiscal, and we've highlighted the stuff about weak fiscal. And as a matter of policy, the Reserve Bank chooses not to comment about fiscal. We don't. We will not tell fiscal what to do. The only time we end up having concerns about fiscal is when fiscal starts feeding into the country risk premium. Because the country risk premium raises what is called the natural real interest rate. And that natural real interest rate is the interest rate at which monetary policy is neither seen to be stimulatory or contractionary. And thus, for you to deal with inflation, when you are having a high natural real interest rate, you need nominal interest rates that are higher. And so, a key driver of what we end up paying as borrowers is what fiscal does. Why? Because anyone in this economy will first lend to government before they lend to all of us. And one of Herco's slides showed that's exactly what the banks and the investors did. They increased their purchases of government bonds because it was attractive to do so. And so entrepreneurs get crowded out, not because the banks are stingy, but because it is attractive to lend to the most credit-worthy in the economy. So that is what you face, then that's how we think about fiscal. How would then GFECRA deal with the fiscal position? It helps in the short term, depending on what you use the profits of GFECRA for. And the agreement that we have with the minister, with the National Treasury, is that those profits from GFECRA would be used to reduce government debt. And if you look in the budget review, you can see the debt trajectory before and after they had taken account of GFECRA. That is how it would be. If we think that GFECRA is some permanent pot that we will go and dig into now and then, ill-advised. It's not going to happen. And actually, any future distributions from GFECRA will be a tiny fraction of what you had currently seen. And it is because these profits in GFECRA had been building over a period of 20 years. So you are not going to find something like that. That deals with all the questions, including the one online. Whilst the people in the room are trying to recover from the shock, can we check?
We have a few more online. So
These people online don't have names, no?
we didn't ask them to submit names, Governor. So one question is, what risks do key events such as the upcoming US elections pose to domestic market conditions? There's another question on CODI. It asks, we've launched CODI, however, we've seen bank clients requesting that the 100,000 Rand cap be revised upwards. Would the bank consider this? Are there any in the room?
Thank you. Upcoming US elections. I don't know why we don't worry about Indian elections that are currently taking place. Oh, Ghana is also voting, by the way, in December. And even in the neighborhood here, a couple of countries are voting. But the US one becomes important. And I suppose it's because one of the candidates said that I will not reappoint that governor. And so there would be uncertainty. It's difficult for us to analyze this because it depends on how much has been priced into the financial markets. And the two candidates stand for two different things. There might be something in the middle. And depending on what the markets have priced, the reaction would be different. So I was telling you that in Mexico, they expected that the ruling party will win a majority. But it won too much, and the markets reacted. In South Africa, it was expected that, oh, maybe the ruling party will just drop. And then it dropped too much, so the markets react. In India, it was expected that the ruling party will win by an overwhelming majority. Now it looks like they might have to be in a coalition, so the markets drop. So these things, trying to find out what the exact impact is, then depends on how much is already incorporated into prices in the markets. And unless you know that, you will not be able to tell what this would be. And as we have seen, these things change from time to time. Even in our own elections, in the run-up, in the week before the elections, there was a different excitement. And then the elections took place. A day after the elections, there was a different excitement. It went the other direction. Today, the markets respond because inflation in the US didn't come out at 3.6. It came at 3.5. It's just 0.1, but they react to that. And in Europe, inflation came out at 0.2, more than what they react to that. And once again, it's a function of how much has been priced in. Cody, the limit of 100,000, that limit of 100,000 is a doubling of what we had previously. We used to have 50,000. We have doubled it. But before I dwell into that, I didn't know we have so many rich South Africans. Can't quite find them because the modeling that we were trying to do was, if we increase this from 100,000 to 200,000, we move from 90.5 to 90.56 or 90.6 or something. You increase it to 300, it does not move the dial. So it didn't make sense to try and increase it any further. And that is why we are not entertaining it. Any questions in the room? Okay, everybody is dying for liquidity outside, and but the three my daughters and the lady, nothing. Okay. Do you have anything online?
No.
Thank you. Okay. You can come and tell people what happens after this.
Thank you, Governor. So that brings us to the end of the proceedings for tonight. Please remember to collect your copy of the current FSR outside, or you can go to our website to obtain an electronic copy there. We hope to see you again on November 28th when we launch the second edition of this year's FSR. And yeah, but obviously the conversations don't need to end here. Please do join us for a networking event at the end of the evening. Thank you all so much for attending.